Thank you, Sophie. I'm afraid it's another French touch accent over English. So I hope you don't have enough of this. It's interesting because, thanks to your poll, Colin, I realize that the investors are where the expectations are the lowest. And that's where they should be the highest, actually. Because at the end of the day, this is the art of capitalism. This is where, the market forces are leashed or unleashed. And that's where we really have to make a difference. Not every company is family-owned. Not every company has a history of Danone. And I remember 30 years ago when I was in HEC, we had the pleasure to hear Antoine Riboud, who explained the two strengths, social and economic forces. That's very special. This is not the art of the system. The system has to change. You rightly believe so. And my point today is very straightforward. We have a window of opportunity for change. That's the good news. The bad news is that this window might not be open forever. And so if we don't use it now, we might lose an opportunity, and it might cost us a lot of money, a lot of time, and a lot of things that the social capital that we discussed this morning. So I'm sorry I have this kind of paper because I just flew in this morning after 12 hours in the plane, so my brain is still a little bit tired. So I really believe that we are at an historic moment, and I'm very happy that we do this actually in a historic place, Oxford. It's an exceptional moment for at least 4 reasons. First of all, we are just, I wouldn't say that we are after the global financial crisis because I think it's still on. It started 9 years ago with the subprime crisis, and we had the euro crisis and so many different waves of this crisis. So I don't want to comment on the crisis. I want to comment on what are the lessons that have an impact on what we are discussing today. And first, I think the biggest capital loss in this crisis is trust. Colin, you rightly say this morning that trust is part of the capitalist system. And I would strongly argue that trust dissipated during the crisis. It's not just the banks. It's also Volkswagen. It's also all these issues. People don't trust the system anymore. So how do we restore trust? If you don't have trust, forget about the rest. The system will not work or will work in suboptimal conditions. So that's very important. You have the frustration of investors. Many of them, the end investors, have the feeling that they've been sold bullshit. I had the bull to be kind of politically correct. You have the growth of reputational risk. More and more people are sensitive to reputational risk. That was not the case 30 years ago. So this is very important. The consumers actually is a very strong point because that's at the end of the day where you make value if you have consumer. As you rightly say, if your product is not good, you will not sell it. And if you have a reputational issue, you will have an issue as well. And the other point, which is also very important, is that this global financial crisis has shifted the power in the system. 10, 15 years ago, the big guys were the banks. That's where the things were defined. That's where influence was made. Now the big guys are the institutional investors, the GIC of this world, for instance, but also the BlackRock, the CalPERS, the AXA, and the various pension funds all over the world. They manage $100 trillion. I don't know how many zero it is, but it's a lot of money. $100 trillion. And not only they manage a lot of money, but they've grown through the crisis. Very little people know that since 2007, the money which is managed by institutional asset manager has doubled. First point. And second point, that the level of concentration has also increased. So close to 50% of that money is managed by 20 companies. We're talking about 30 or $40 trillion managed by 20 companies. A company like BlackRock is managing $5 trillion. A company like Vanguard is managing $2 trillion. So that's really a big change, which is largely unnoticed and still not really understood and not really analyzed. It's just the beginning. So this is really the art of the system, and you should not underestimate it or just kind of dismiss it and say, well, we have no expectations with these guys. You have to have expectations with these guys. Because at the end of the day, it's your money as pensioners, as savers. You are in charge. Second element, which makes this moment an historic moment, it's the economic and financial circumstances of today. We are in a very weird situation. I was a member of the Financial Stability Board for 3 years. So maybe you don't know what the Financial Stability Board is, a gathering of central bankers and head of treasury which discuss the financial system as a regulation. I've never heard so often the word, we are in uncharted territories. You tend to think that central bankers know where we're heading to. Well, the truth is that, like all of us, they're trying to find their ways. So we have negative interest rates in so many countries. We have a flat yield curve. We are discussing whether the secular stagnation is a myth or a reality. The IMF mentions a new mediocre. So we just don't know where we are. And interest rates being negative, I mean, that forced investors to think twice, because how can you pay pensions if your interest rates are negative? So how do you move in that direction? And on top of that, you have a growing correlation between asset classes. Usually you could play equity versus fixed income. Now everything is going in the same direction. So this is very special. That's part of this kind of special window that we have to have in mind. Third element, the world, despite this kind of weird environment, is thinking big. Last year, 2015, might be a historic year. I don't know yet. We agreed in July last year on objective to finance development. We agreed in New York in September on sustainable development goals, and we agreed in Paris on climate change. These are big things. I mean, 180, 190 states committed to these goals. It's not a joke. It's not just a piece of paper. All our presidents and head of state have signed this paper. So either we consider this is serious, and we have to make a difference, and this is all of us in this room which have to make a difference, or we just say, oh, it's another piece of paper. Who cares? I believe we have to care. It's a good news that despite all the tensions in the world, we've been able to sign on this paper, but we have to make this paper a reality. If not, it's going to be another set of papers that will be forgiven for history. Fourth point, which also makes this moment historic, you have new approaches, new questions being raised, and this is very new. Just take an example, Larry Fink, who is the CEO of BlackRock, so managing $5 trillion, 5 with 12 zero, I think. Again, that's a lot of money. He circulated a letter this year to all the CEOs of the Fortune 500 company. I don't know whether you received it, Emmanuel. Just a quotation. While we urge strong support from corporate leaders for taking a long-term view, many companies continue to engage in practice that may undermine their ability to invest for the future. And the letter goes on. So that's very new, that the largest asset manager on earth kind of address the CEO and say, oh, guys, we have a problem in the system. We have also this discussion this morning. I don't think it's an accident that we have this discussion this year in 2016. And their expectations are growing. I think it was very interesting when we discussed around the COP21 and climate change. On the one hand, you had the public track. So people say, OK, we need to find $100 billion from the north to the south to finance climate change. But who can seriously believe you can change the world with $100 billion per annum? Again, sorry for the big figures. The GDP of the world is $100 trillion. You will not bring the world to a low-carbon economy with $100 billion per annum. That's not true. It's a symbol. You have to address that symbol. It shows generosity between the North and the South. That's great. But the real change will come from what I've called the silent revolution, the change in practice from investors, the market forces moving the direction of a low-carbon economy. This is not just because few companies will feel good. It's because the system will change. And that's, for instance, about carbon pricing. If you put carbon pricing in the system, that forces people to integrate this in their model, in their Excel spreadsheet, and make a difference. So that's really what I have in mind. And that's the point that Mark Carney actually has gone off the Bank of England and chair of the Financial Stability Board made in Paris last year. He called it the tragedy of the horizon. And that's exactly what we are discussing today. What is a tragedy of the horizon? It's a reference to a tragedy of the commons, which are very well known in this country. Tragedy of the horizon, you say nobody cares. The climate change is like way beyond the horizon any political decision, any business decision, any regulatory decision. It's 10, 15 years down the road. But we know that there is a catastrophe coming in. So how do we handle this? So we have to address this tragedy of the horizon and take this on board now through carbon pricing, for instance, and other tools. So my point is that all this is crystallizing today. It might not last forever, so we have to see this opportunity. So that's why I would like this conference today, this discussion today, to be a call for action, to be a call to redefine the ecosystem in which we are all working, to redefine the investment ecosystem. We cannot just continue more of the same. We cannot just do the corporate social responsibility game. It's nice. It is just nice. So it's really touching the heart of the system. The complexity is that the system is complex, actually, because it's made of regulations, of rules, of practices, and culture. And that's why you have to be bold. You have to be impatient. But at the same time, you don't change culture overnight. You don't change business practices overnight. So you have to start, you have to be ambitious, you have to be demanding, and you have to put a continuous effort. So regulations, of course. I mean, I've heard many people complaining about the quarterly report. And I've been a CFO for many years, and that was a pain to prepare these quarterly calls, etc. I don't think there is a way back. You cannot decide, OK, no, we move back from half-year results or yearly results. Now that people have information in a world which is demanding for information, forget about that. So we have to play with that. But we have to review regulations of each actor, pension funds, asset manager, banks, life insurers, etc., what is in their regulation forces us to be short-term versus long-term, etc. I think we need to have this in mind. I think this is very important. It's a long job. We have to take into account things like the carbon pricing, I think, again, and maybe define other types of pricing which takes into account social capital in a way or another. Again, the regulators can do that. And the regulators, if they impose that, I mean, it's going to be easier for investors to take this into account because it's a rule. I mean, any investor is following books and rules and principles. So that's very important to take this into account. Second thing, business practices. I mean, let me mention a few. Benchmark. I mean, everybody's benchmarking against everybody. So it's a system where, this is a famous beauty contest of Keynes, where you don't have to be you don't have to find who is the most beautiful. You have to find who is going to be found the most beautiful. This is a crazy system. How can we escape this? I had just an anecdote. When I was a group CFO of Crédit Agricole at the peak, actually before the Greek crisis, I had conversation with Amundi, our asset management company. And the people say, yes, we don't think buying Greek debt is a good idea. And I share their analysis. But the problem is that if they don't buy Greek debt in early 2009, they lose 7% of return on this. And the benchmark makes them look bad. So because you want to look good, you have to do stupid things. And you know it's stupid. So that's the reality of the system. So we have to find ways to avoid this, to free people from looking at benchmark, for instance. You also have to discuss asset classes. When you're an investor, an average pension fund, you cannot think out of the box. You are not allowed to think out of the box. So what do? You create new boxes. That's probably what we have to do, so that people can think in different boxes. So we have to create new boxes, like infrastructure as an asset class, like impact as an asset class, and others. I think this is very important to get out of the equity, fixed income, alternative boxes. I think this is very important also to enter into these very practical things. Again, it's not just the CSR thing. We have to invent new products, new distribution channels. I mean, in Europe, we have, I don't know whether I could discuss Europe in the UK those days, but sorry, I couldn't. We have the so-called Juncker plan. The Juncker plan is say, okay, we have 20 billion of public money and we want to get to 350 billion of investment. But the fact is, you need private investor in the middle. How do you get there? So you have to think a system, products, channels, rubber stamp. I mean, this is what it is. It's as simple and technical as that. We have also to address the cultural factors. That's why the role of opinion leaders, like Larry Fink, for instance, Mark Carney, CalPERS, and others, or GIC, is extremely important. Because these people in a world where everybody is looking at everybody, if the leaders move, the others will move. There is a herd effect there. So I'm coming to the end, because I think we have all these practical things to address, and it's not that difficult. Last thing, you just cannot be talking. You need to verify. I mean, again, as I say, the trust has dissipated in the system. So you need to measure what I'm saying. You have a suspicion. I mean, I've heard the greenwashing things many times. So are you going to do a little bit of washing on the system? You can't afford to do that. So you have to be serious. It means that you have to go to beyond the CSR. You have to have third-party rating this, not only the former rating agencies, but probably new agencies, new models to assess that what you are doing is exactly what you are doing and not just kind of nice report. We have to move also on the integrated reporting. I know most people don't care about accounting, but accounting is critical. This is critical because every CEO and CFO knows they have to sign. They engage their responsibility. So what they say in their report is important. So the way we account for things is important. So I know it was not my favorite topic when I was at your place, but I see it's extremely important. And everything which is related to integrated reporting, where it's not just about finance, but about strategy and responsibility is important. And we have to push in this. We have also to say that everything that we do is not a trade-off. It's not finance versus other things. It's really finance and other things. You don't discount your profit because you do good things. It's doing, as we say, good and well. So I have to finish, yes. Okay. So my point, and again, that's very important. So these are things that we have to define. We must also encourage an institutional support for that. I'm very excited that the G7, under the UK leadership, worked on that 2 years ago. We have to work with the Financial Stability Board, with IOSCO, which is the Organization of Securities Authority. They have to give their blessing to that. But if they give their blessing, coming back to my point on the boxes, people will feel more comfortable that if the big guys say it's okay, then it can be okay, and then we can redefine. So I have a call for action here, Colin Mayer. Maybe we should call from Oxford all these guys to work together. and designing the new rules. This is really something for the G20. This is really something for the, I'm not joking. I mean, people think it's far away and we have no influence on that. These people are dying for topics to discuss. I really think we have this window of opportunity. I'm serious. We have this window of opportunity. Again, let's imagine in 3 or 4 years from now, US interest rates go back to 5 or 6%. I can tell you everything we discuss will be gone because people will go back to buy US Treasury because it's so simple and so rewarding. That's the art of this window of opportunity. So don't waste this opportunity. Don't waste it, please. It's not just about being bold, it's about being fast. Thank you very much.
Thank you. Thank you very much, Bertrand. A very spirited set of recommendations, which I think we will discuss with the rest of the panel. So I'm going to invite Goh Kok Huat to join us. Goh Kok Huat is the president and CEO of GIC Real Estate, an arm of the Singaporean Sovereign Wealth Fund, GIC. Good morning.
Good morning.
How's the jet lag?
Better now compared to yesterday.
Oh, good.
But it always takes a while, as with most things.
Indeed. Starting Saturday morning probably doesn't help. So, Goh Kok Huat, Bertrand was calling for, I mean, he's making a lot of recommendations from his talk, which I think are thought-provoking. And he's certainly calling for a more holistic and patient approach to investing. GIC Invest Patient Capital. Can you tell us a bit more about patient capital and what it requires in terms of approach and investor style or appetite?
Yes. First of all, let me say that it's a privilege to be here, and I absolutely agree with what Bertrand said. A lot of people think about patient capital and impute in it all sorts of different notions. But really what patient capital is about, in our view, is that your time horizon becomes long. And when time horizon becomes long, you look at things quite different fundamentally. And I would suggest that all the things that we talked about this morning, one of the fundamental issues that we really need to solve is the matter of short-termism that has creeped into businesses as well as to investment. And because businesses and investors have taken a short time horizon, they are solving to a very different set of metrics. When if you lengthen their time horizon, then a lot of these metrics will change automatically. You will begin to think about mutuality, you will begin to think about people, you'll begin to think about planet, because if you want sustainable long-term results, it precludes you from doing certain short-term fixes in order to get to the instant gratification that we are also accustomed to today. And so we believe that is the crux of the issue when it comes to the matters that we are discussing today. And if we can all successfully change the time horizon of investors and businesses alike, I think we are in business, because then you will get convergence of the various different objectives, be it financial, social, or people, or planet.
So what role can business leaders concretely play in influencing investors towards this long-term thinking?
There are really two things, and Bertrand has mentioned both of them. One is regulation, the other is practices. In regulation, obviously all the business leader can get together and exert the collective influence on regulators, and investors like ourselves, we try to do that too. And then the second is practices, and that's the area, I think, where companies can do a lot, businesses can do a lot, and we as investors can do a lot too. And it is about creating that ecosystem within the companies that we manage that will facilitate people exhibiting behaviors that tend towards maximizing long-term value rather than thinking about short-term gains. And that truly is not an easy thing to do. because human beings, being human beings, we have behavioral tendency that gravitates towards the short term. So it is almost unnatural, it needs encouragement, and if business leaders could all do the same, I believe we'll get to a much better outcome.
So going to GIC's approach, what difference the GIC approach makes concretely, if any, to the companies they invest in, and also in Singapore? What is your investing approach create? What sort of outcomes it actually creates, would you say?
Yes. So one of the things that we have thought about really is, given that our capital is long-term in horizon, how do we design an entire system to encourage our managers, internal or external, to focus on long-term gains? So one of the things that we did first was to say that, hey, guys, in the strategies that you manage, you're assessed on a 5-year horizon, if not longer. And so that takes pressure away from measuring just the 1 year, or even worse, just the day-to-day, because public markets mark to value every day. And if you pay attention to that, really, no matter what else you do, people being people, human behavior is such that you will manage that number. And so I think businesses, while I do agree to a certain extent with Bertrand that you can't roll back the quarterly reporting, we need to think really seriously about how are we going in such a regulatory environment, get our people to think beyond that number every 3 months or every day. And so in GIC, we've sort of designed the entire compensation system to reflect that time horizon. That's part of the ecosystem. Having said that, that's not enough, right? And this goes into the practices that Bertrand was talking about. No matter how you design any system, if the fundamental starting point is flawed, then people will just simply game the system. And we see this in Wall Street played. Oh, sorry, maybe I shouldn't say that. But we see this played out time and again. So no matter what compensation system you design, it comes back again and again. And so in our firm now, there is a tremendous emphasis on what our values are, what we represent, on what our investing principles are, and what that represents. And we talk about it every day.
And that translates in your dealings with investee companies?
Yes, we do. Not perfectly, but we do. And part of that, no excuses, is also because we are in a journey, as the previous panel described. We only started this about 5-6 years ago, so we are on that journey. And part of that journey is convincing all our people internally that this is the way to think about things, right? And it's not easy.
Great. Well, let's continue the conversation, and I would like to invite our final panelists, last but not least, Alex van der Velden, Partner and Chief Investment Officer of Ownership Capital. So, Alex, welcome to the panel. You describe yourself as a fundamental long-term equity investor. And having talked to you, you explained to me you sort of an active investors with for a good cause. Sometimes active investors are labeled as short-termist. But can you tell us a little bit your philosophy around active engagement and what are the leading indicators of companies integrating a mutuality approach in your experience?
Sure. So Ownership Capital is a fairly new fund manager. We started in 2013, but our strategy originally began in 2008 inside a Dutch pension fund called PGGM. And PGGM had a visionary CIO who asked himself this question already back then: how do we invest with the view genuinely to the long term when the ecosystem we rely on to invest is focused primarily on these short-term indicators? All of these short-term indicators are unlikely to add up to a good long-term outcome for our pensioners. And so my own background actually had been in private equity, where you naturally have a 10-year fund life and you have the attitude of an owner that you bring to it. And I proposed a very similar investment process to invest in public companies, where you only own a handful. We own 20 companies in our portfolio, which is more than sufficient for diversification. But you are an active owner of all of those companies. And one of the things we realized early on is that there are a group of leading companies like the Danones of the world in which we're invested, like Novo Nordisk in which we're invested, that are already on the right track. And with them, all we need to do is keep pushing them and persuading them and telling them, stay on the track, but please go faster, because this is important. But there is a vast ecosystem of companies out there, especially based in the United States, who would think that this discussion here today belongs on another planet. I mean, it's very easy to talk to people who have the same minds, but in the US, the Friedman philosophy as being profits only is alive and well. And they would not agree with a lot of the things that have been discussed here today. So for those companies, it is our job as an investor either to determine they are not investable for us, because that sort of approach we believe over long term destroys value, or use our voice as a shareholder, that's why we call ourselves ownership capital, to encourage them to move in the right direction. And so the engagement we do with our companies is very different from, again, those companies that are already on the right track, versus many companies in the US where they don't even have a sustainability strategy yet. They don't even think that these things affect their business. And so their first conversation with us is, first of all, fascinating. We've never had a question from an investor about these issues. And second of all, what do you even mean by this? And then you literally have to explain some of the basics of what we all, I think, here agree are the genuine factors that create long-term value. And I think that is what is fundamentally missing. And it was interesting to see the data points on the expectations from investors, because it's absolutely correct. The only reason ownership capital exists is because our first investor, the Unilever pension fund, asked themselves the question, okay, we're doing a lot in our core business, but what about our pension fund? And corporate pension funds, by and large, are completely insulated from many of these corporate social responsibility thoughts. And they're managed by a treasurer somewhere low down the line, and as long as they're getting their numbers, nobody really bothers with it. And occasionally there's a board discussion about the fact that it's underfunded, and then people start throwing money into hedge funds because they think that's the best way to boost their return. But there has not been that fundamental rethink, which Unilever did fortunately begin a few years ago, because actually Paul Polman was asked the question exactly at a forum like this, what about your pension fund, where there's 20 billion or so of assets invested? So they've become leaders in this area. But that is still the exception. The vast majority of pension funds are either just beginning their journey or they're not on this journey at all, because they're insulated from a lot of the forces that businesses are exposed to in terms of consumers. The average pension member takes no interest in their pension fund. And that's where it's very difficult, because they just don't get that pressure.
But that would go against the other data point to say that consumers, retail investors, by extension, are,
Well, retail investors are not very interested in this
exactly.
either, because people do not understand the links between these factors. I had a fascinating speech by an advertising executives at the Principles for Responsible annual conference last year, where he was serving a client that sold biscuits. And they had just relaunched their biscuit brand in Europe, and sales promptly dropped 30%. And the company, it was one of the biscuits companies, went to the advertising agency and said, gosh, we don't know what to do. We don't understand what's happened. And he said, well, why have you relaunched the brand? Well, we've made it healthier. And the first thing the advertising executive asked is, you didn't put that on the label, did you? He said, oh, absolutely, 30% less fat. And he said, well, consumers are psychologically wired to think that there's a trade-off, when all of their taste studies had shown there was no difference. The same is true in finance. People inherently will believe that if the way you invest has good societal benefits, it will cost them money. And of course, the socially responsible investment industry of the last few decades has indeed delivered poorer outcomes in general than other sorts of strategies, because they were focused only on the ethical dimensions. And the key is, of course, to bring these important business drivers of the future into the fundamental financial matrix, as Bertrand was mentioning as well. Not to say, well, now we're going to focus on different goals. It is to expand what you mean by your goals, being absolutely a financial return, but delivered in a long-term sustainable way. You cannot go to a pensioner at the end of their lives as they're preparing for retirement expecting a certain salary that they have been promised and say to them, well, we're going to cut it by 50%. We did not achieve our return objectives, but there's a lot of people in Africa now who are better off. People will not accept that. I mean, we invest, for example, on behalf of Oxfam's pensioners. Those people have worked hard lives, often in remote locations. They need that safety just as much. Interestingly, therefore, some of the values-based organizations have less of an interest sometimes in ESG integration than those who are financially oriented because they are even more fearful of having that financial certainty.
So if shifting investor expectation of return is not an option, shall we explore a little bit some of the solutions that Bertrand proposed?
If I may answer that, for investors, it means proving that you do get better returns from this. Because we all sit here and say, oh, of course, you can hire better young people, and therefore you'll be more productive. You have to show that translates into better results. And so the only reason we exist as Ownership Capital is because we have beaten the benchmarks by more than 5% per year since we started in 2009. And without that proof, nobody would have given us money.
Can I just add to what Alex is saying? I think to frame the issue as accept lower return for all these things that needs to be done for sustainability is the wrong starting point. The right starting point is convergence. Doing all these things will get you to better financial performance. And if we can all put our minds into proving this, then I think there's convergence, and then you find that all the behaviors, correct set of behaviors were lined up, and you'll be in a virtuous cycle.
Because I do agree, if we are incapable of demonstrating this will remain a little niche, and you don't change the world with a little niche. End of the story. So it's going to be nice, but will not change anything. Whereas if we move into that direction, then people will understand it's okay. Not only it's okay, but it brings additional value. And to echo what you said, I mean, I was the chair of the pension committee of the World Bank, which is supposed to be exemplary. And it took me 2 years to get there, adopt the PRI, I'm lost with the acronym.
The Principles for Responsible Investment.
Yeah, Principle for Responsible Investment. Exactly for the reason you say. We are not the World Bank, we are the pension of the World Bank. Say, well, but in people's minds there is some connection. Yeah, but you know, this is our money. No, but you might laugh, but I'm pretty sure that in all organizations might have the same type of conversation. Absolutely. So it's very difficult. It's very difficult. So if you don't demonstrate that there is value for money there, forget about it. It's just going to be about nice people doing nice charitable things, but you don't change the world with that.
Great. We have only in 1 minute I'll ask questions. What about your call for regulation? I mean, this is notoriously difficult to collaborate, private sector collaborating with regulators on regulation. I mean, do you think that will break through the situation in the States that you were referring to? If you could maybe expand a little bit and have a discussion among yourselves.
Well, I think if you allow me, because I have the privilege to have been a regulated and a regulator. And it's difficult. In today's world, don't underestimate this. We are truly global. So I remember when I was a French banker, which sounds maybe weird, but I was a French banker.
No contradiction.
No, I was even worse than that, actually. I was the president of the regulation committee of the European Banking Federation. So I was technically the chief lobbyist of the bankers. And I come to my French regulator and say, oh, you have to do that and that and that. And the guy say, okay, the Bank of France say, okay. But then when you go to the regulators, I mean, you have people from Indonesia, from China, from Brazil, from all over the world. And so the French voice is 1 out of 20, 25. And to agree on global rules, because it has to be global. You cannot just change the world in 1 point. This is extremely challenging. So it's not out of reach, but it's extremely challenging. That's why we have to join forces together, not only business, but I would say trade unions, NGOs, government. It's together that we can create a movement. That's why I call for action here, because we have different people in this room.
Right.
We are lucky enough to have people like Mark Carney and others which are willing to move in that direction. We can help them. They will not do it alone. And regulation is one of the key. Practices will take more time, but regulation is one of the key. Again, if you take the example of carbon pricing, it's a very straightforward example. If we get to carbon pricing, I mean, everybody will be aligned. You have no choice. There is a price on carbon. You put this in your model, Excel spreadsheet, and then you change.
But carbon pricing in the States is not flying. It's not something that is currently really taking grab at all.
Yeah. Again, that's the point. It doesn't happen overnight. But would you have bet on carbon pricing in China 5 years ago? The answer is no. This being said, China is probably the most advanced country in terms of carbon pricing. And the truth is that they are the biggest greenhouse gas emitters in the world.
Right.
So we cannot say it will never happen. I mean, in that case, as some people say, well, we stay home and we relax. I mean,
Alex, do you want to comment on that? And then
well, I think the best thing the regulators can do is at least get out of the way. You know, there were regulations around fiduciary duty that meant people felt that this was absolutely something they couldn't even do in the first place. Some of that has been rolled back. To the extent that that's completely cleared away, at least it removes a barrier to thinking long term. And I think, secondly, you know, we don't need to rely on people's goodwill here. I mean, if what we say is true and the returns are better, then people will, and we start to see this the last few years, more and more also mainstream fund managers trying to copy the sort of ownership philosophy that we started, simply because the returns and clients want that sort of product. So it's very, very early days, though. Other than ourselves, the only other sort of global equity fund manager, and they've been around even longer than we have, that we see even remotely thinking in this direction is Generation Investment Management, started by Al Gore and David Blood 10 years ago. That's just way too small of an ecosystem. So you have a lot of traditional active managers dying away. That's a good thing. But you have yet to see a large pool of new strategies that are investing in the right way. And that's why, you know, folks like GIC, when they think about how to change their managers, they're stuck with a lot of managers that they can't necessarily get rid of because they don't have alternatives, but who maybe are not necessarily there yet. So there it is about the mandate you give those managers, giving them longer term benchmark to hopefully create some of that changing behavior.
What do you need to accelerate that?
So indeed, Alex is right. First, I would say that you need to engage on multiple fronts. In our view, a little different from Bertrand, is that regulations are not that easy to change. And so while you engage on that front, we have taken the approach that do things that are within our control, and that's the practices of the managers that we have internally, as well as the practices of the managers that we appoint. And then to push things further, we also think about it in the following manner. The more we can get our peers to think along the same lines as us, it will help, because in time to come, if we all think alike, then we become a force to be reckoned with, and regulators will then have to take notice. And so together with the Canadian pension plan, we have started a forum to focus capital on the long term. And we invite companies from time to time, our peers from time to time, sit around the table, discuss issue about what are the impediments of focusing capital in the long term, on the long term. And that's been tremendously helpful in creating awareness and in spreading the message and in beginning to change that game, both from a practices front as well as from a regulations front.
Great. I would like to open the floor for question. The lady there. Sorry. Oh, I'm so sorry. Yes. Marcelo Palazzi, co-founder of B-Lab Europe.
I want to say hi, Marcelo Palazzi, B-Lab. I want to follow Alex in saying that, in fact, there's a lot happening in the world. We as B-Lab, we have actually a division called B Analytics. It's b-analytics.net. We have 10,000 companies. They're all impact companies already in this platform. We have about 92 funds that are investing in these companies. And we see that there's actually a big transition going on quite rapidly, you know, following, you know, what Generation Investment Management others are doing. You know, Bill Gates already, announced he's getting out of BP, etc. So my question is, two questions, quick question. One is, we should sometimes look at unlikely places. i.e., what is happening out of Silicon Valley venture capital funds? What are they doing with their money? And secondly, it's that the real challenge is not so much to sort of have the transition 100% to impact investing. It's just to actually get enough to start making a difference. So there is a coexistence issue that we will have in 10 years' time, a lot of impact investors, but we start with traditional investors, and that's also fine. So the question is, what do you look at new places, different places for finding these kind of investors? And secondly, what do you think about this coexistence between impact and traditional investors?
Great. The lady there, if you want to stand up. So that, Simon, if you can pass the mic, throw it if needed. Who next want to ask a question?
Yeah. Hello. So I think my question is directed both to Goh Kok and Alex. Goh raised a very important point of convergence, and I'm interested to know, is there any convergence of interest, say, or time horizons between companies like GIC and ownership capital? Because GIC has the advantage of looking at long-term horizons, but traditionally, pension funds have been very passive in the investing structure. And if we look at companies like ownership capital, you look at the short term, which is the main complaint of companies, but activist investors are now, the unlikely angels. You're holding companies accountable for what they're doing. So I was interested in the kind of convergence over time horizons between companies where Goh Kok and Alex are working.
Great. The gentleman there, Simon. We have to check it. Yeah.
Sorry, so my question is about individual underlying investors. We've talked about them very much as if they are passive, don't do very much. Can anything be done to help the underlying investors, small retail investors, rather than see this all just as a financial transaction alone, to engage with the underlying stocks that their funds are investing in, bringing their values to bear and beginning to influence that way as well?
Great, thank you. Great question. Do you want to go, Alex?
Sure. Just on the point on individual investors, before I joined PGGM, I actually started an NGO called Share Action, which is all about engaging that. The reason I left that to go back into the finance industry is because I felt there was a lack of funds who were genuinely doing what we needed them to be doing. Just to answer the lady's question there, we actually look at a 10-year horizon. We're not short-term, and we're not activists. There's a real difference between activists who try to force management to do something and engaged owners that try to persuade them and work in partnership with them. If we cannot persuade Monsieur Faber to take an interest in these factors, then we will find companies that will. So there's a real important difference. So actually there is no gap between that multi-decade horizon that they have and that we have. It's just that there's not many fund managers who think that way because of that benchmark culture that causes people to be very short-term.
I mean, is there any scope for collaboration, in trying to engage retail investors and business that engage consumer on a daily basis? I mean, is there no scope for collaboration on that front?
Well, I think the leverage that consumers have is it always, change starts with a very small group of dedicated people. If a small group within a pension fund pushes their pension fund to adopt these policies, there's often tens of billions of dollars of capital in these pension funds. The World Bank pension fund, 50 billion. So I think that rather than going directly to the companies, if you can get your pension fund to start speaking with their much larger voice, that is really one of the great opportunities for consumers.
Can I maybe just
talk
to that question a little bit? I was told this story by the ex-CIO of Tiercraft, and they are in charge of many pension funds. They're in charge of pension funds, and their constituents have, for a while, always feedback to them that, why don't you invest responsibly with these and these and these companies? And so what they did was they designed products that invest only in these companies and allow their pensioners to opt in. And what they've discovered is that while people push for that, where the rubber meets the road, not a whole lot of people take up that option. Now, the question is why? Exactly, and I think this is where things become tricky. And this comes back again to the point about proving that things like that leads to better outcome, not worse outcome. And a lot of it, in my mind, and the point I'm trying to make is that it is not easy. A lot of education has to go into it, in my view. And you fundamentally have to prove the notion that it is a better outcome. And when you do that, then I think the outcomes with retail investors will be dramatically different. It's not an easy.
It's the say-do gap that Unilever was talking about yesterday as well. Bertrand.
For me, it's a very central point, because we tend to say they should do this, or they should do that, or they should do this. The problem is that it's not they, it's us. No, but we should not exclude. I mean, when we separate in the poll the investor, the consumer, the staff, etc., these are the same person. We have one brain, but we cut our brain in pieces. So as an individual, we are a consumer, but we cannot be schizophrenic. So behave as a consumer one way, behave as an investor another way, behave as an employer a third way, and so on and so forth. So if we separate this and we remain passive, nothing will happen. That's why it's a call for engagement. I mean, we have the capacity to make changes. It's not they, it's not people up in the air. So as pensioners, as you say, you can, I mean, these were pensioners from the World Bank, which kind of helped me move into the PRI. And these are consumers that push the company to do things and so on and so forth. It's the same person. So we cannot exclude ourselves from the discussion. So obviously, we have more responsibility here on stage than the student, but they will have responsibility soon and so on and so forth. So we have to move with that in mind. It's not they, it's us, each of us.
Maybe if I could just add to that, I think the reason these historical approaches have failed is because they're just dividing those two and say, let's throw some ethical principles on top of a fund, but that's the full extent of the analysis. Instead of bringing those things together, how is Dano and CSR policy helping them to build a business with greater longevity that ultimately leads to better profitability? That's really the question. And you can't do that question quantitatively. You can't do it simplistically. You have to dig deep into those companies. So it requires also going back to the basics of investing, which, you know, kind of the way Keynes originally did it, owning a few companies that you know really well and being an engaged shareholder. That's the way to integrate this.
But you still need someone to orchestrate that engagement between all these different stakeholders.
Well, there is no master of the world, so forget about that. No, but I'm serious. So the world is very complex, but the world is also more connected than ever. So we have the capacity through whatever technologies, whatever organization, etc., to create expectations. And again, the leaders, I mean, reply to expectations. So if you create expectations, people will move. It's no surprise that 2 years ago, again, the G7 commissioned a report on impact investment. I mean, that didn't come out of nowhere. So you have to continue to push in these type of directions. So it's not somebody to organize. It's all of us putting pressure on the system.
Great, thank you. It could have continued, I think, for another half an hour, if not more. But thank you very much for your patience. Sorry.